Welcome to the deep dive. Today we're cracking open a massive institutional toolkit, the Wolfram Risk system from Cynosura Risk, and we're giving you the inside track on its most powerful features.
We really are. We're cutting through all the jargon, all the complexity. If you've ever wondered how professional fund managers actually measure and forecast risk for, millions or billions in capital,
Right.
this is designed to give you that core framework. The mission here is really to understand how the pros structure their thinking around risk.
And it seems like the entire system really just hangs on one fundamental choice, doesn't it? It's about which lens you're looking through.
It's all about time. Are you looking backward or are you looking forward?
Okay.
So we start with the retrospective, the ex-post analysis. This is your classic P&L, your profit and loss. It's what has already happened.
Got it.
Then we pivot to the perspective, the forward-looking view. That's exAnte. And it's all about value at risk, or VAR. It's about what could happen.
So exPost is looking at the receipts, and exAnte is trying to read the crystal ball.
A perfect way to put it.
And the system covers everything from P&L to VAR to scenarios and exposures. So let's start with what we know for sure. The hard data, the P&L.
Let's do it.
So when you're digging into historical performance, I see a user can customize their P&L view, daily or weekly data, month to date, year to date. But what about the really complex strategies? I'm thinking funds that use leverage.
That is a fantastic option, and it's a key practical feature. It's the percentage of net asset value, or percent AV configuration.
Okay, what does that do?
Well, imagine your fund runs with leverage. Say you have $100 million in capital, but you can leverage it up 2 times.
So you're trading with 200 million.
Exactly. So in the system, you just input 200%. And from that moment on, all the performance and risk calculations are based on that doubled $200 million exposure.
Wow, so it immediately reflects the true magnitude of the capital that's actually at risk.
Precisely. It changes the entire context.
Okay, so once that's set, let's move beyond just the simple total return number. Let's get into the serious ex-post stats that reveal a fund's stability.
Right. The metrics that show how effective the risk management has been in the past. The first one I always look at is maximum drawdown recovery time.
And that is?
It calculates how long, usually in months, it took the fund to recover from its deepest historical loss, from peak to trough.
So it's not just showing the risk of loss, it's quantifying the pain of going sideways.
That's it. It's not just how deep the hole was, but how long you were stuck in it before you got back to even. It's a measure of resilience.
That makes sense.
What's next? Then you look at efficiency with the Kalmar ratio. This one is simple but powerful. It compares your compounded annual return directly against your maximum drawdown.
So how much bang did you get for the biggest buck you ever risked?
You got it. And related to that is the ulcer index, which specifically measures the depth and duration of those drawdowns. It's almost a literal calculation of how much pain you endured.
And of course, none of this exists in a vacuum. You have to benchmark it. If you're comparing yourself to, say, the MSCI China Index, which metric tells me how far I strayed from that path?
That would be your tracking error. It quantifies the volatility of your returns relative to the benchmark. How much did your journey wiggle and weave compared to the index's journey?
And for an active manager, you want some wiggle, but you need to know how much.
Exactly. And the ultimate report card on that is Jensen's Alpha. That's the risk-adjusted excess return you generated over what the benchmark should have given you.
Okay, so these ex-post metrics give you this really deep, multidimensional picture of what happened, which of course leads us to the much harder question.
What's going to happen next?
So we have to move from that realized P&L to predictive VAR. The exAnte forecast. How do you even start modeling potential future loss with any kind of confidence?
Well, you have to choose your engine very carefully. The system gives you 4 distinct VAR models because what works in a calm market might get you killed in a volatile one.
Let's walk through them. I assume we start with the statistical standard.
We do. That's the parametric or analytical model. It just assumes a normal distribution of returns.
The nice predictable bell curve.
Right. It's fast, it's computationally simple, and it works pretty well for stable markets where things are, behaving as expected.
But reality is often not that neat. So if I don't trust the statistical assumptions, I guess I just look at what actually happened.
And that's your second option. The historical simulation model. It's grounded purely in past performance data, no assumptions. It's simple, it's real world, and it's a pretty strong indicator.
If you believe the future will look like the recent past.
That is the critical if.
Okay, but what if I need to model for the crazy stuff? The black swan events, the outliers that can just wipe a portfolio out. That has to be Monte Carlo simulation.
That's where Monte Carlo shines. It uses stochastic processes to generate this huge array of possibilities. But the crucial choice it gives you is to switch from a normal distribution to the student t distribution.
Okay, explain that. Thin tails versus fat tails.
That's the perfect analogy. The normal curve has thin, fragile tails. It discounts the probability of extreme events. The student t distribution, on the other hand, has fatter tails.
Meaning it assumes those crazy swings are more likely.
Much more likely. It's explicitly designed to increase the simulated probability of extreme variations, giving you a much more conservative and frankly more realistic VAR-R for volatile assets.
That distinction feels incredibly important for managing real-world risk. So what's the fourth model, the hybrid model?
The hybrid is built for speed and reactivity. It uses historical data, but it applies a decay factor, a lambda of, say, 0.99.
What does that do?
It's a mathematical lever that makes sure yesterday's data counts for a lot more than the data from 6 months ago. So if the market regime just completely changed last week,
The hybrid model is already listening to the new reality.
it's listening to what the market is telling you right now.
That's a huge insight.
Yeah,
So beyond picking the model, the time settings have to be critical.
absolutely. The first is your horizon. If you're using daily returns and you set the horizon to 5, you're estimating the potential loss over the next 5 calendar days.
And the calc type sets the foundation for that forecast.
Correct. 730 daily means your calculation is pulling from 2 full years of daily returns data. You have to align your data window with your forecast horizon.
So once you have that VAR number, you don't just stop there. A portfolio manager needs to know where the risk is coming from.
Exactly. You have to decompose it. VAR decomposition turns that single number into an actionable to-do list.
What does that look like?
Well, a manager needs to know 2 things. First, if I sell asset X, how much does my total risk go down? That's incremental VAR. It's the marginal impact of a trade.
Okay, that's for making a decision.
Right. And the second is, what is asset Y's actual contribution to my total risk right now? That's component VAR. It helps you find the single biggest driver of risk in the portfolio.
Got it. Now, shifting gears to more specific exposures. Liquidity. That's a classic risk. You have a huge position, the market turns, and you crash the price just by trying to sell. How do you flag that?
The system has a brilliant, simple metric for that, ADV 100. It stands for position percentage of average daily volume.
So what's a bad number?
If your entire position is, say, 150% of the stock's average daily trading volume, your ADV 100 is 150. And that is a huge red flag. It's screaming, warning, if you try to exit this position in a hurry, you are the market.
That's a very practical, immediate warning light. Okay, what about fixed income? For a bond portfolio manager, what's the go-to metric for credit risk?
That's CR01, which stands for Credit 01. It tells you exactly how much your position's value will change if the credit spread widens by just 1 basis point or 0.01%.
So when credit markets get shaky, that's the first number they look at.
It's the first number. It shows you the raw sensitivity to corporate distress.
And finally, let's talk options analytics, the Greeks. For a complex portfolio, the net Greeks must be a lifesaver.
They really are. They consolidate all that complexity. Let's use the sample data we have. A net delta of 79.65%. That's simple. Your net long, strong, directional bias.
Right, but the net gamma is negative, minus 1.37%. Why is a negative gamma so important?
Negative gamma is a critical risk indicator. It means that your strong delta, your directional bet, will actually decrease if the underlying price goes up.
Wait, so as you're making money, your ability to make more money slows down.
Precisely. It hints at a non-linear risk profile. It suggests you might have a strategy that's short volatility and that needs very careful watching.
And we also see a negative net vega of minus 0.25%.
Which means your portfolio value is sensitive to changes in volatility. Specifically, if implied volatility in the market goes up, your portfolio value goes down.
So those 3 numbers give you this incredible snapshot of your directional risk, your convexity risk, and your volatility risk.
All in one place.
Okay, so let's move from just measuring risk to actively managing it. I'm fascinated by the pre-built historical scenarios, simulating the Lehman crash, the Russia-Ukraine invasion. But if I own an instrument that didn't exist in 2008, how is that relevant?
That is the key analytical leap. The system takes the historical market shock, the size of the move in rates, in volatility, in credit spreads,
Okay.
but it applies that shock using today's correlations and volatilities from your current portfolio.
Wow. So So I can see how the Lehman crash would impact an ETF that was only created 3 years ago.
Exactly.
Yeah.
Because it models how the ETF's current components would behave under that kind of historical stress. It makes history relevant to today's portfolio.
That's incredibly powerful. And alongside those historical shocks, you have open protocol non-predictive shocks.
Right. These are standardized, brutal, hypothetical shocks.
Give me an example.
They test specific factors by plus or minus 10%. So the OP currency 10% shock shows you what happens to your portfolio if major currencies arbitrarily jump up or down by a full 10%.
They're designed to find your weak spots.
To isolate your structural vulnerabilities, and once you find one,
You go to the what-if editor to try and fix it before you place a trade.
absolutely. This is the portfolio manager's sandbox. Before you spend a single dollar on commission, you can model adding a new position, say in Fisker Automotive, or adding a QQQ hedge, and it will instantly forecast your new VAR and new exposures.
It turns planning into risk-managed execution. But none of this is worth anything if you can't trust the models in the first place. That's backtesting.
Backtesting is your validation step. It's simple, really. It compares your historical VAR predictions against what actually happened, your actual P&L, over a chosen date range.
It answers the question, did my model actually predict the limits of my daily losses?
It does. And the system makes it easy. It runs diagnostic tests, like Kupieck's POF frequency test, and gives you a simple green for pass or red for fail.
And if you see red,
You know you need to go back and adjust your parameters. Maybe switch your VAR model to one that accounts for those fatter tails we talked about.
and very quickly, there's also a correlation view. How does that fit in?
It's all about proactive diversification. We saw how important correlation is for those historical scenarios. Here, managers can see the forecasted correlations, green is positive, red is negative, to help them build a more robust portfolio.
So when you put this all together,
Hmm.
what's the core insight here for you?
The takeaway for me is that comprehensive risk analysis is this constant, sophisticated balancing act.
Between the past and the future.
Exactly. Between understanding your historical performance and stability, the exPost, while simultaneously using predictive models and stress tests, the exAnte, to prepare for anything from a past crisis repeating itself to a hypothetical shock no one's seen before.
And you're always making a choice about computation. With options, you can use the fast delta gamma approximation, or you can switch to the slower but much more precise full revaluation method.
That trade-off is constant. You face it with backtesting too, a quick check over the last quarter or a comprehensive run over multiple years.
Speed versus precision.
And that trade-off is often what separates a real-time, actionable decision from a perfect analysis that just arrives too late.
Which leaves a final thought for you to take away. In the middle of a fast-moving market crisis, when everything is on the line, how many seconds of computational time are you willing to sacrifice for the analytical certainty of that perfectly precise, fully revalued risk number?
The answer to that question could determine the fate of the entire portfolio.
A powerful place to end. That's our wrap on this deep dive into institutional risk management frameworks. And thank you, as always, for providing the source material that made this analysis possible.
My pleasure. Until the next deep dive.